American Strategy Program here, and I co-direct with my partner, Cheryl Schweninger, the Economic Growth Program at the New America Foundation. It's great to have Cheryl here because he's usually in New York. Wish we had our camera on him. I want to say hello to the 100 or so folks that are on the internet now watching as well. Today we have a really interesting program, and we don't often take the time to think through the human dimensions of economic change. Today, Peter Gosselin, who's well known as the national economics correspondent for the Los Angeles Times and has been a good friend of the New America Foundation's efforts to try to struggle with what is happening economically, both on the domestic economic front, on the international economic front, to what degree is there an arbitrage with what's going on in the geostrategic realm, how do you fit these pieces together, what should be the appropriate role and framework for public policy thinkers and practitioners. We've been at this for some time. Recently we've had some very interesting programs with Tom Gallagher, a former regular on the Louis Rukeyser show, I just learned, but a great guy who's a finance expert here in town, sort of thinking through this. And he was just here a few days ago with Leo Hindry and had an interesting chart we may talk about later, looking at public attitudes towards the government, that there was a period, particularly just before Reagan came into office, when the public's interest in thinking that the government needed to do more was ending, and then we entered into this sort of anti-government perspective for a role. Now he says there has never been, he says, a dramatic shift and change in public attitudes towards government today. And I mentioned that chart that Tom Gallagher shared because in Peter Gosselin's new book, which of course we have outside for all of you who would like to pick it up and have Peter sign them, the book High Wire, the precarious financial lives of American families, looking at the personal sides of these issues and talking through them. And Peter has brought together a new array of data and statistics and thinking through these questions, which I think are quite important. But as we look at these, this issue and the stress and tension, it reminds me of the old debate that Eddie Luttwak helped launch with his book on sort of thinking about turbo capitalism, turbo economies. When I worked in the Senate in the 1990s, and we were looking at American attitudes towards the economy and their own personal lives, it was very interesting because they saw at that time that the level of anxiety was sky high in the country, but if they could just get to Social Security period, they would be okay, or if they could just get here. And they all thought everyone else was doing worse than he or she was doing. But we did feel in the 1990s this high level of anxiety, but it was the time when we were led to believe that you saw a shift in the burden of responsibility from corporations and other parts of the political economy doing less and more of it moving into the individual space, but at the same time, a lot of structures, particularly in education or pension provision or whatnot, not quite as flexible. So we had despite what people may be saying, an inflexibility and in the portability of benefits and whatnot, but a heavy presumption that the flexible player was labor in this particular case. I don't want to put more words or thoughts in Peter Gosselin's mind. And here to make some comments, we have Ellen Seidman, who's director of the Financial Services and Education Project in New America Foundation's Asset Building Program. She serves as the Executive Vice President of the National Policy and Partnership Development at Shorebank Corporation, and just a wizard thinker on economic and finance issues. Ellen is going to provide quick commentary after Peter's interesting presentation on his new book, and then we'll be back with Q&A and discussion. So without further ado, please help me welcome Peter Gosselin.
Thank you very much. I want to say right off, I'm honored to be here today and grateful both to New America and to Steve Clemons for sharing the extraordinary platform for public discussion that they have created. I propose to come at my subject from the following angle. Rather than simply walk you through the major themes of the book, I want to aim those themes at our nation's current economic crisis in hopes of framing some larger account of it, one that helps us understand where we are today and where we need to head. I do this for two reasons. First and most practically, it makes no sense for somebody like me to write a book such as I have, and even less sense for people like you to buy and read it if it says nothing about what's happening in America and the American economy today. Secondly, though we are now nearly a year into the current crisis, it seems to me that our explanation of its causes and a working out of the implications both for our politics and our policies remains remarkably thin. So you might read this as sort of lessons from the current crisis. At any given time in America, there is a dominant story about how the economy is performing and treating those who live and work in it. And it is only against this story that we can draw key lessons from the current crisis. The dominant story for most of the past generation begins in the late 1970s when prices were soaring, key industries were sinking, and society generally seemed at a dead end. Our nation's leaders, others before and with him, but most memorably Ronald Reagan, reacted by stomping on the economic brakes, deregulating industries, reeling in safety nets, and generally remaking the economy in a much more free market mold. This free market makeover of America took. Inflation declined, growth revived, a host of new high-tech industries rose to replace sinking old ones, and certainly by the late 1990s, large numbers of Americans were enjoying sustained and broadly shared prosperity. The economy's performance, at least until recently, was so spectacular and so spectacularly different from what had preceded it that economists dubbed it the Great Moderation. But from the very outset, there were hints that something else, something distinctly less pleasant than prosperity was going on. Americans in growing numbers, and this is not just poor Americans or blue-collar Americans, but also affluent, white-collar ones, were telling pollsters they were increasingly uneasy about their economic prospects. Now, for the last generation, economists, commentators, economic journalists such as myself, and think tankers sought to explain this unease and find its underlying causes. And in this effort, we were remarkably unsuccessful. We spent years, for example, looking very intently at jobs and whether bad jobs were outrunning good jobs. And then along came the late 1990s, producing hundreds of thousands of new jobs a month, many of them high-tech, high-paying jobs, and that explanation bit the dust. We spent an equal amount of time looking at income inequality, which clearly is on the rise and which clearly can strike a nerve with many Americans. But I think that inequality does not explain much about economic insecurity or anxiety, not at least among the majority of Americans who are amazingly tolerant of the widening gulf between rich and poor, just so long as they're sure they're on the right side of the divide. These failures led many analysts to conclude that when Americans reported feeling economically insecure, they didn't have the faintest idea what they were talking about. Indeed, one commentator, Greg Estabrook, wrote a book a few years ago that said that reports of insecurity were evidence of their opposite. He argued, in effect, that we'd become so prosperous we could afford to sit around and wonder whether we were prosperous enough. But I think the Estabrook position cannot stand. Reports of insecurity have continued to grow, and the economy has dealt a series of sharp blows, of which the latest is only the most dramatic, and as we know today, it's very dramatic indeed, to the notion that what we're living through is a great moderation. Where we went wrong in our earlier efforts to understand insecurity's causes was in looking at the wrong place, for example, at individuals or solely at individuals at their work, and for the wrong development, for example, good jobs being outrun by bad ones. The right place to look is where most people get their economic sense of themselves and their economic prospects, and that is in their families. American working families up and down a wide swath of the income spectrum. The right answer about what's causing economic insecurity is that the rewards of increased prosperity have come at a large, but until recently largely unnoticed cost. An increase in the risks that families face of taking steep financial falls as a result of a laundry list of setbacks that the economy and life can deal you in the course of a working career. Of course, more families are taking falls more often now because the economy is in trouble. But just to be clear, my argument is not that these increased risks are the product of the current set of troubles we face, but we're underway well before them, and unless something dramatic changes, will be underway, will continue well after we get out of the current mess. Instead, this increased burden of risk is the product of a more globalized and technical economy, of changes in family structure and circumstances, and most importantly, of a shift of risks, of the costs of such things as layoff, job-stopping illness, injury, and so forth, from the broad shoulders of business and government to the backs of working families, from the working poor to the reasonably affluent. In Highwire, I make three kinds of cases that American families are running greater risks than a generation ago. I make a quantitative case by stealing a page from the stock market, where the standard measure of risk is the beta of a stock and tells how volatile that stock is or how much its price swings up and down around a broad mean. I develop a similar beta for family income. My headline finding is that the income volatility of families in the economic middle has roughly doubled over the last generation. But the most striking finding is that the increase in income volatility has been remarkably democratic, affecting working poor families with little education in spades, but by now reaching into the ranks of college-educated families with family incomes running into the several $100,000. And let me just stop aside here and say one thing a minute. This issue of income volatility has prompted some discussion over the last few years, since I've written about it, since New America fellow Jacob Hacker has written about it. I want to be clear that what I think I am doing in looking at income volatility is not finding a new and never before identified risk to American families. I am giving you a measure, a riskometer for American families. There is a story that goes with it that tells you why you should take it as a measure of risk. But I don't say that the swings themselves in family incomes or the increase in swings pose in and of themselves a risk. That's important because I think a lot of critics of this notion think that wobble is a new danger that we're saying exists. I make a structural case that families are running more risk by examining the economic struts that hold up working families and that have held them up for generations, and by showing that virtually every one of these struts, jobs, yes, but also benefits, housing, health, education, investment, retirement, even your bought and paid for safety net of your homeowner's policy, have been weakened over the last generation. And I make a narrative case by telling the stories of families of various means and across the country as they've experienced the economic changes of the last generation. Let me just pick a couple of struts and introduce you to a couple of people. Take benefits. When Washington and the presidential candidates talk about benefits, they are usually talking about public benefits, Social Security, Medicare. But the benefits, the safety nets that really count for the vast majority of working-age Americans are their employer-provided benefits, the health insurance, the disability coverage, the employer-orchestrated, if not contributed to, 401ks. Most Americans, probably not in this room, but most Americans are not aware of this, but their grasp on these benefits, their right to receive them, their remedy if they don't, is governed by a single federal law, ERISA. ERISA was intended by its congressional authors to protect employee benefits. We know this because it says so in the preamble of the law. But over the past generation, the Supreme Court and increasingly conservative federal appeals courts have rendered a series of decisions that have turned ERISA on its head, making it easier for employers, benefit administrators, and insurers to limit the benefits you can claim or deny them altogether. Or take retirement, and this is a story you know. Nowhere is the shift of risk, in this case from business to families, more complete than in the move from traditional pensions to 401ks and similar accounts. As you know, with traditional pensions, the burden for setting aside the necessary funds, investing them, and delivering on the promised amounts to finance people's old age rests largely with employers. With 401ks, those burdens now rest squarely with you. Now, theoretically, you could handle this task, but study after study has shown that large fractions of Americans make a hash of the business. And as I'll show you in a minute, the ranks of these poor performers include some of the nation's finest minds. Let me introduce you to just a couple of people. Diane Andrews Clark, let me just say, I follow the stories of a dozen or so families up and down the income spectrum in the book, and try to show the trends that I write about with my numbers and the structural analysis, how they play out in people's lives. Diane Andrews Clark and her husband and 3 children lived north of Boston in Haverhill when she first encountered ERISA. At the time, she was working at an AT&T factory for good wages and what she thought were spectacular benefits. Soon after the birth of her 3rd child, her husband, Richard Clark, began drinking. Under Andrews Clark's health insurance policy and under Massachusetts state law, anyone covered by the policy who needed alcohol treatment was due 30 days of inpatient care paid for by the insurer. But when Andrews Clark tried to collect from an insurer, the insurer refused. When she tried to collect a second time, the insurer offered some days, but nothing like the 30. Richard Clark eventually dried out in a maximum security prison and died. Andrews Clark sued the insurer, Travelers, at the time, arguing that her husband's death and the fact that she was left to raise her 3 children alone was the direct result of the insurer's failure to pay. But because the Supreme Court and the appeals courts have limited employees' rights under employer-provided health insurance policies, such as Andrews Clark's, essentially to getting the benefits that were originally denied, and because Richard Clark, being dead, was not available to receive them, Andrews Clark got nothing. And if you want, I'd be happy to read a quote on this subject from Boston Federal District Court Judge William Young, a Reagan appointee. Let me just jump ahead to something on a little lighter note. Let me introduce you to Harry Markowitz. Over the last 2+ decades, advocates of the 401k revolution have defended do-it-yourself retirement accounts by saying that if Americans aren't doing a good job of managing their retirement money now, they'll learn with time. I went about trying to test this proposition by interviewing most, and I can see that I missed a few, most of the Nobel Prize winners in economics who are still alive, and asking them what they had done to prepare for their dotage. One was Harry Markowitz. Markowitz is the father of what's known as modern portfolio theory, the notion that we know of as you shouldn't put all your financial eggs in one basket, but should diversify. But when it came time for Markowitz to make his diversification decision, he all but punted. Here's the 80-year-old Markowitz on the subject. I either had in my head or had just written down the most revolutionary theory of investment the world had ever seen. And here I was asked, how do you want to invest for your retirement? And I said, 50-50. A rudimentary split of his retirement savings between stocks and a riskless bond fund. He went on. I'm 24, 25, I'm never going to die. I had other things to think about. In retrospect, I should have done something more sophisticated. The idea that increased risk of any sort would come in a match set with the increased reward of any sort would come in a match set with rising risks is uncontroversial in financial and economic circles, where essentially all of life is seen as a series of risk-reward trade-offs. Neither was the idea foreign to the late 70s, early 80s theorists of America's free market makeover. And by the end of the 90s, the idea had settled into something approaching a consensus, certainly among economists and policymakers, if not the general public. Not only were the rewards of greater prosperity coming at a price of increased risk, but that this was a good, not a bad development. At least 3 arguments were deployed in favor of this trend. It was good because it got the incentive right. In the current situation, that would mean that a reckless home borrower would pay for his recklessness, while prudent ones would purportedly be rewarded. It was good because business and government could no longer afford to or wanted to help families bear risk. And finally, and most grandly, it was good, so the consensus said, because the prosperity of the preceding period had lifted many, many Americans to a new plateau, where they no longer had to rely on labor alone to support their families and themselves. That's because they now had assets and financial access. They had houses and credit cards and home equity loans and mutual funds and 401ks and trading accounts. And with these, they could play right along with every other economic unit, investing, diversifying, hedging their way to the good life, and perhaps something fabulously better. Families, so this argument went, were now equipped to bear the new burden of economic risks they'd been allotted. Which brings us back to where we started. The dominant story of the last generation is that America was at an economic impasse. It broke that impasse by recasting its economy in a free market mold and prospered. Something else happened in the transaction. Working families were left to bear a wide range of economic risks they'd previously been helped to bear by business and government. But so the argument, at least among the economic cognoscenti, went, prosperity had given these families the wherewithal to handle this new task. The current crisis strikes the dominant story at this last step, that the great trade-off of the era of more risk for more reward was a good deal for most Americans. It leaves none of the arguments in favor of the trade-off undamaged, and some, I would argue, in tatters. Consider getting the incentives right. As appealing as it might be to want the borrower, or for that matter, the lender, in a no-doc, no-down mortgage that goes bad, to suffer, the spillover effects are proving so fantastic that it can't possibly be that we have the incentives properly aligned. Consider the resulting foreclosure from one of these ridiculous mortgages, not from the point of view of the borrower, but from the point of view of the guy next door, or somebody in the same subdivision, or arguably homeowners up and down the two coasts of America at a minimum. Many of whom were prudent borrowers, mortgage borrowers, but yet are paying a substantial price. 2, business and government can't or don't want to provide safety nets, the safety nets they did in the past. Perhaps not. But I would argue that we've seen some pretty spectacular rollouts, not real-ins, of safety nets so far in the current crisis. I suspect when the history of this era is written, the Federal Reserve's decision to create the primary dealer credit facility in the term securities lending facility and to essentially slip a protective net under most, if not all, of the nation's financial system will loom extremely large. And I simply ask a question whether creating safety nets on the fly like this is really any way to conduct a society. Finally, on the question of most families having reached some new plateau that leaves them able to shoulder their new burden of risk, I think that the current housing, credit, and economic crisis is eloquent. Families are not, after all, like every other economic unit. Households are not hedge funds. The portfolio notion of our most intimate social building block fails. We are, in the language of finance, so long labor, income, and houses that we can't possibly diversify our way out from under the risks that we've been assigned to bear. Though most of us and our families are better endowed than the households from which we came, most of us are every bit in need of buffers against the worst setbacks that the economy and life can deal out during the course of a working career. The dominant story of the past generation may have made sense at its inception, but the story, and most certainly the case that the risk shifts that it has involved of the past generation are good things, is by now deeply flawed. For most Americans alive today and for their children, restoring some semblance of balance and stability to their economic lives, reestablishing a minimal sense of mutual obligation between employers and employees, between citizens and their governments, is likely to be every bit as much the defining challenge of our time as the war against terror or any other laundry list of hurdles that we have to cross. Change will not come easily, certainly not with Washington's finances in the dismal shape they now are in, but come, I suspect it will, and when it does, we will have reestablished a set of values and protections that lie at the heart of what most of us mean when we say America. Thank you.
Thank you, Peter. Thank you very much. And for comments, now we have Ellen Seidman. And Ellen will move this microphone down to...
Eye level?
Yes, there we go.
Okay. Thank you very much. This is a fascinating book, and it certainly adds a new and important dimension to the question of, even before the current crisis, why were people feeling so bad? And it's Peter points out, it's not just income inequality, it's certainly not income levels, but income volatility, the uncertainty, may well be a critical answer. He makes a really convincing case, both analytically and in terms of the stories, all of which resonate, and some of which, particularly the health insurance stories, are absolutely horrifying and well worth reading. And in fact, there were times, especially before I got to the end of the book, where I actually wondered why Peter was pulling punches. I want to raise two questions about his thesis, then consider something that we here spend a lot of time on, namely this assets issue, which he has set up to some extent, and I think we're going to have one of those conversations where we agree in the middle, but we'll both talk from the edges. And then just some additional kinds of responses that we might want to consider. First, I really did find myself wondering at times whether there really had ever been a golden age of income sufficiency coupled with stability, and if so, for what part of the population. For example, in 1983, only 20% of the workforce was unionized, and it's now down to 12%, but what about the other 80? And at most, only 50% of the population's of the workforce has ever been covered by retirement plans of any sort. So was there really a golden age of stability that extended beyond one of the story characters, or one of the people that is a subject of the book, namely Richard Koss Sr., who's a union man who is contrasted with his sometimes flying up, sometimes flying down son. Second, and this is nowhere discussed in the book, and it struck me as an interesting omission, the period that Peter studied is also the period during which the United States was moving from some of the lowest levels of immigration to some of the highest. So in 1970, only 4.7% of the population was foreign-born, which was the lowest level that it had been since 1850 when they started keeping records. By 2002, this number had reached 11.8%, which was the highest level since 1920, and believe me, it didn't include all of the actual immigrants in the country. So what effect did this sea change have not only on the fact of volatility, but also what volatility means to the population and how people feel about it? I don't know the answer to the question, but it'd be worth thinking about. Now, if we think about increased income volatility, I think we really do need to think about asset poverty and wealth inequality. And this is where we're going to end up talking past each other unless we're careful. We here in the Asset and Ownership Program are really concerned about the question of, in essence, no assets. Not the question of, if you have some assets, can it substitute for a good, stable job? Can you as Peter puts it, can you diversify your way out of the risks that the labor market has created? But I do think that we can't just sort of leave the wealth issue aside. I mean, in 2004, 17% of American households had zero or negative net worth, and another 30% had net worth below $10,000. It was much higher among Black and Latino populations than among white populations. So that you've got a really heavy part of the population, and this is before the current situation, who don't have much cushion, who are even more stressed by volatility because they know they don't have much cushion, and also have, and this is closer to Peter's question, little to leverage with which to recover. So I do think we need to be thinking about both income volatility and these issues relating to assets at the same time. And I know we're probably going to have a conversation about home ownership. This is one of those places where if you only look at the headlines, you can find yourself in a different position than if you dig a little bit under. And I totally agree with Peter that the true victims here are the neighbors and the communities, much more than the actual borrowers. But what's really interesting is that if you talk to people who worked with lower income borrowers in a really responsible way, they've come through this okay for themselves. Now, their neighbors may not have, and that may be creating problems for them. But I was on a panel yesterday with the man who heads the Latino Community Credit Union in North Carolina, for example, who said he's got 0 delinquencies on his mortgages. That's pretty impressive given who his clientele is, namely new to America Latino immigrants. So I do think the asset building thing is important. I mean, even Peter gives a nod to children's savings accounts in the baby bonds form. We can talk about 529 plans. We can talk about tax reform strategies that put a higher share of asset building incentives in the hands of those who need them. And there are a host of other asset building strategies that range from the rather small to the very large that you can find on our website, which is www.assetbuilding.org. Now, what also struck me was the thought that any number of the families in the book might well have benefited from a strategy that is critical to wealth building, which is developing financial competency starting at a really early age. In an ever-increasingly complex financial services environment, it is absolutely not a panacea. I do not want to be quoted as saying it is the solution. It is not the solution, but it is a necessary condition to people really being able to see their way through the environment, the financial environment in which they now have to live. In his final chapter, Peter suggests a number of strategies to deal with income volatility, including health care reform, where he seems to favor a single-payer plan but thinks it's never going to come to fruition, so we better figure out what's second best. ERISA reform, where he points out that the Supreme Court has gingerly started down the road, but probably not fast enough to be meaningful, especially with respect to health and disability plans. And insurance regulatory reform, which is a huge and complicated topic that is absolutely ripe for debate, not only because of the Katrina situation, not only because of the health care situation, but also because we have a bunch of insurance companies coming in looking for a major change in insurance regulation in the form of an optional federal charter. So let me just put 2 other ideas on the table, and then we can go to Steve battering us all. So the first is this question of unionization. We're not going to go back to the glory days of unionization, but are there other kinds of collective action? Are there other kinds of purchasing alignments, arrangements? Are there other kinds of systems that can, at the very least, supplement an enhanced governmental safety net and perhaps even substitute for some parts that might otherwise be picked up that way? And secondly, I have with me a second book, which is Robert Shiller's newer book. And of course, he's looking a little bit like a prophet again, this time because of his perspective on house prices. And he has suggested the concept of livelihood insurance, in which people would be able to insure against the possibility that the career path they chose would turn out to be far more risky than expected because, not of their own effort, but because of environmental changes, of globalization, things like that. And the insurance would pay out in a manner that's both an income supplement and a cushion to enable retraining. Shiller's entire system depends on extreme data mining of exactly the sort that Peter raises as undoing the collectivity and risk sharing that really is the basis of insurance. But it solves one of the problems that Peter points out most vividly, namely training intensively for the wrong occupation. And I just think that some further discussion on that point might be useful too. Thanks very much.
Thank you, Ellen. Thank you very much. I want to acknowledge that we've got C-SPAN Book TV with us here today, and glad that, and we have a lot of folks watching online. So when we move the microphone around, I'd appreciate it if you would identify yourself and make your question as crisp as possible. We'll have a good exchange. And I also want to leave time for those of you who'd like to get the book and have Peter Gosselin sign it to have time to do that. They're both very provocative discussions, and I'm sort of intrigued with Ellen's comment about the banker you mentioned not having any defaults in his current portfolio because I have lots of other bankers I could introduce him to who sort of share a different story. So that's sort of an interesting take on today's circumstances. Plus, I've been with a bunch of Treasury Department officials and David Hale, an economist from Chicago, and others who are quite worried about sort of systemic shock this next year in the number of banks in the United States that go under sort of, default and greater regulation. So there's a systemic level at that. But, it's kind of, interesting. But on another level, there's a vignette. The vignettes in Peter's book are really moving. And there's one of a Mr. Burtless of Bethlehem Steel who essentially got trapped between the period of sort of a very big load, Peter, that Bethlehem was carrying for its previous unionized workers, and the company. I knew the CEO of Bethlehem when it went under, went bankrupt, and lots of people were left. And I was always intrigued because I never understood the dynamics of how that happened. Does a firm just simply go under and then there is no provision or mechanism for covering the sort of health liabilities and obligations of that firm? And when you look at another firm, say U.S. Steel today, where the stock price is sky high because of the demand for steel, are those workers in a far better place in general, and are they resolving their obligations in ways that Bethlehem was not when it was healthy?
Well, I mean, I'm sorry. The interesting thing about Bethlehem is that, and Ron Burles's experience is that. It seems to me that not only did Bethlehem go under, but so did the company that carried its workers' comp insurance, Kemper Insurance. So this is a man who was depending on a safety. Let's see, in synoptic form, Ron Burtless is a unionized electrician at the Burns Harbor plant, the largest and the last of the great integrated steel plants that were built in America on the shores of Lake Michigan. In 2003, 2004, on Easter Sunday at night, he was working in the coking ovens. An electric train that carried red hot coal to be doused broke down. He went to fix it and fell in a runoff trench that carried boiling water that was used to cool the coke. And basically boiled himself to the kneecaps. In the time he was in the hospital, Bethlehem sold all of its assets, but essentially none of its liabilities, to
International Steel.
To International Steel. Thank you very much. To Wilbur Ross, and it's been subsequently sold again, and Kemper. The carrier of its workers' comp insurance, went under, and so this man who was depending on a safety net that was created not in the Great Society, not in the New Deal, but all the way back in the Progressive era, found himself with no safety net, and with $90,000 worth of bills. All I intend by the story is to say that if you want to have a sense of what, here is a man who assumed certain things about his working situation. We can argue whether those were proper assumptions or whether they turn out not to be, but he was told that there was a workers' comp safety net under him. He was also told that he would get a pension after 30 years. There wasn't a workers' comp safety net under him, and his pension is now with the PBGC here in Washington. If you want someone to bear more risk, at minimum, you've got to let them know that these tasks have been shifted to them. And the real weight of that story, as I tell it, is that many of these risks have been shifted to people unbeknownst to them.
Thank you. Let me open up the floor, and Sam will bring this to you. We're going to be careful of the camera and stay out of its view, okay? That's right here.
Crawl.
Yeah.
Al Milliken, Washington Independent Writers. How anxious should Americans be about the amount of debt they have from the rest of the world? and the value of the American dollar in relation to other currencies around the world.
So the question is about just how does the currency issue basically aggravate the high wire, frustrate the high wire, make it, or does it affect it at all?
Look, I mean, as an economics correspondent for the LA Times, I have some views on that. But since we're talking about this book, I don't think the attempt in this book is to stop looking at the economy from the top down, and certainly a question about foreign exchange rates and the dollar and the dollar value in foreign currencies is a top-down question, and to try to look at the economy essentially from out the front door, as Americans would see it, and so that a lot of these broad trends that are influencing what happens are, if you will, distant thunder in this book. I simply have not wrestled with them. I mean, I clearly, I think there is a geopolitical, geoeconomic process going on that should be very concerning to Americans as we no longer. If, in fact, the outcome of what's going on with the dollar is that we are no longer the reserve currency of the world, that is going to come as a rude shock to America. But for purposes of this book, I don't wrestle with that issue.
Thank you. Lou Uchitel, in his book, does something similar, and it surprised me. I don't remember the name of his book, but it came out last year. Yeah, and in which he was looking at the trade displacement, but was fundamentally not looking at the sort of big macro dynamics, but rather looking at the individual, the displacement, the emotional level, and the anxiety levels, which seem to come to at least a similar level of analysis as your own.
Yeah, but I just say in that regard, we have a huge statistical system that's devoted to looking at the economy from the top down.
Right.
I think one of the things that motivates a lot of economics reporters is that we have a comparatively weak system of looking at the economy as Americans would from the front door out. And one of the things Ellen mentioned, Professor Schiller. Robert Schiller has been a great supporter of the books, and one of the things he says, and I quote him as saying in the book, is that American households have been handed these new risks, but they have not been handed new tools. Now, one of the and in the book, I say they have none of the tools that, for example, Wall Street has to assess risk. Of course, that criticism is weakened at the moment because it looks like Wall Street's tools were pretty crummy too. So, but I mean, it is quite amazing that we've been handed this new task, and that essentially, except for a few nostrums like "don't put all your eggs in one basket," that's our risk management tool right there. You've got it in a nutshell. So,
Thank you. Yes, sir.
David Stace, Policy America. If you wanted to look at this issue from the bottom up, a good place would be with the secondary labor market, sometimes referred to as the contingent labor market,
Yes.
in which this kind of insecurity has been chronic for whole spectra of families. And that being the case, I would question your use of metaphors in the safety net, which is to say, for many of these families, economic shocks, income volatility is so traumatic and so constant that not only do they have insufficient income, they actually find themselves at the precipice. So that a more accurate metaphor, if you look at subprime lenders, and not just subprime mortgages, but payday loans, refund anticipation loans, that what you have is a vortex that's not just inert, it's sucking resources out of
you.
those
I'll get to
families.
And I just say, there are two chapters in the book, one on poor families, working poor families, and one on a category that I call unjobs, which is essentially the contingent labor force. All I'd say about treating the measure as a measure instead of a new risk is that at the end of the day, the reason income is flying around is because of the same old dangers that have faced Americans for a very long time. And I don't want to get into an endless debate about, ooh, is this a new danger? The old ones are plenty enough as it is. I mean, so.
Ellen, did you want to comment?
No.
Okay.
Yeah, Jed
Jed
Schilling with the Millennium Institute. And two points I appreciate your comment on. One, I think you've described part of this, but there's been a systematic effort to shift risk from what I'll call the financial elite to much of the rest of the population, which, as you say, is getting up even to people with college educations. And it's not a free market. It's changes in the rules and regulations that have protected industries from risks and shifted it to the workers or to the customers or things like that, so that a small group of people, even when their companies fail, get their golden parachutes while everybody else is laid off. So one is this really a systematic shift in risk away from the elite? And the second is a risk that you may have discussed in the book, I haven't read it yet, about for families, which is as the health insurance system is folding, as pension plans with businesses and stuff are folding, the working class is facing an added risk of having to support their parents as they go into retirement and don't get adequate safety net support. So that's a supplemental risk on the bulk of families who don't have huge fortunes sitting in the bank.
I guess the only thing I'd say is I am not a conspiracy theorist about this. I do not think that what that we see here at least started as a systematic effort. I guess my evidence for that is that it has occurred in piecemeal fashion over a very long period of time. It's occurred and one of the reasons why, to the extent this has any originality, it has originality, is because the pieces were so separate. There was retirement over here, and there was homeowners insurance here, and there was that we didn't notice that there was a pattern across them. So maybe I'm not, count me naive, but I don't. There have certainly been times when I think risk has shifted to households in systematic ways. But a lot of this, I mean, again, I'm one of these people who buys a Toyota and thinks that everybody has a Toyota. I mean, I now see this under every nook, every rock I turn over. But I mean, take an issue that was big in California, electrical deregulation. Nobody did that to shift risk. But as it turns out, one of the things that happened was that the redundancy of our grid was lessened, and a lot of the danger of that fell to the guy stuck in the elevator when the power went out, right? I mean, Californians were vividly aware of that at the beginning of this decade when their system came to. But again, that didn't happen as part of some broad conspiracy to say not only are we going to take retirement and shift the burden to them, but also the quality of the electrical system. And I
didn't mean a complete conspiracy, but simply that
You need to be on the mic.
I didn't mean a complete conspiracy, but many of the decisions and the way the government and the courts have favored things have generally said we're favoring shifting policies that end up shifting the risk.
Yeah, I think actually the shift was a risk away from capital into labor, and that it may have had the impact you're talking about, but I think it was part of a broader context, which was to shift risk away from the corporate entity and therefore its shareholders to the individuals. And as Peter's pointed out, there were at least some people who believed that would be good for the individuals, but I don't necessarily think that everybody who made that shift had that rationale.
Yes, ma'am.
Hi, Shannon Christian, I'm early childhood policy consultant. Peter, you mentioned that education was part of the structural case about the increase in risk, and I wondered if you could elaborate on that and tie it to decreased quality of education or schools, or if your thought is a whole different line of thinking.
Terrific. And
Thanks.
after Peter responds to that, I've also asked him to respond a bit to some of Ellen's provocations in her remarks.
her terribly provocative remarks. Let's see. The case I make in the book does not address very directly the issue of the quality of education right now. it focuses mostly on college and advanced degree education. And the argument is simply this, and I want to be clear about this. It's good to have more education than to have less. I have twins, a boy and a girl, and if they think they're not going to go to college, they've got another thing coming. But that said, I think that education is one of those issues that Americans love as a solution to almost anything that ails you.
Except for the ones that home ownership is the solution to.
And then homeownership is the other solution, and then we've got it all solved. So I don't think education provides as much of an insurance policy against economic falls as it once did. And we just look at this decade, skip my arcane volatility measure. I mean, you know, the fraction of college-educated headed households without health insurance has gone down 3 percentage points in this decade, 2000 to 2006 or 7. Now, of course, the fraction of high school educated headed households has gone down 9%. So it's some protection, but it isn't the protection that Americans had come to think it was. Can I just change gears a minute and just respond to a couple things that Ellen said?
Absolutely.
First, with regard to the measure, is the measure distorted by immigration? Immigration is clearly one of the huge trends that has occurred across this period of time. And sort of ceteris paribus, you would think that immigration would tend to cause an increase in volatility because these are people who have just arrived, they're going from zero to something, or they're going from something to zero more than kind of other Americans. We've looked at that. The truth of the matter is that the database, the database that has followed these Americans across time for 40 years, has had this problem. The database is called the Panel Study of Income Dynamics. It's supported by the National Science Foundation. It's administered by the University of Michigan. You know, between the inception of this database and today, along came this huge wave of immigration, and they have tried to shoehorn in samples of immigrants. It's not, they've done only a partially good job of that. So if anything, my risk measure understates the volatility. And then to our second point, was there ever a golden era? Well, it seems to me that if I'm right that my measure shows there's more risk, whether there was a golden era in the past or not, what we need to cope with is the fact that now we face even more risk. And the question seems to me to be, where is it best set? The default position in the last generation has been that households are a great place to put it. And I would argue that at minimum, if you're going to make the shift to them, you got to let them know, and you got to give them tools to do something about it. But I guess I would ultimately argue, and this goes to Ellen's point about asset building, that just like with education, I'm not against having assets. You know, I mean, having more assets rather than fewer is a good thing. The question is, does it then mean that you can essentially self-insure? There is a great impulse in the American political system today to say that's so. I mean, the notion behind health savings accounts is that you can self-insure to a much, much greater extent for health care costs. And so I'm not against building assets or programs that help Americans build assets. It does seem to me that these arguments that we basically can get, I mean, look, at some level, if we would sort of started everybody else with baby bonds of $500,000, each one of you starts life with $500,000, and you go from there, clearly you are much more likely to be able to self-insure. It's not going to happen, you know. And so what I'm what troubles me about the asset building agenda is that it is a premise in an argument that says, therefore, you can bear a lot of these very big risks that previously you were helped to bear. So
This is so cool. I'm going to have to, when Ellen's book comes out, invite you to be the, the commenter. Let me ask just one question before I go to the back. And with your volatility measure, which is interesting, are you doing anything other than the book right now to sort of try and talk that up, or to get a broader application or thinking? I mean, it's one thing to sort of come up in a book and say, I've established this new interesting beta for thinking about, you know, volatility in the working family situation, but it's interesting, and I'm wondering, have you done anything or thought anything about trying to get some of your other colleagues in the economics reporting profession to think more systematically about alternative measures?
yeah, I'm dying to get my colleagues. I hope this helps.
Yeah.
To get them to look at it. Let me answer that question this way. I do think that these measures are interesting. I have been toying with ways to try to make them more accessible to people. So, for example, you know the board game Life? Remember that? I have engaged a bunch of very young people at the University of Southern California, which has a graduate program in video arts, to try to design a video game that would be sort of like the board game Life, but would be weighted by my statistics. So you would get hit with shocks, and you would see your income drop, and then you could choose college or not college or da-da-da. Now, it turns out that we've had this terrible problem, which is that you have to design it so that there are a series of what we term befalling events, stuff that happens, right? And there's a little generational thing going on. I keep getting lists from them that have economic events like, Buddy comes and mooches off me for 3 months. And I keep saying, I don't think that cuts it. You know, we were talking about
iPod stolen.
So it's still in the works.
Yeah. Actually, I want to put a cultural piece
Yeah.
in here, because one of the things that, as we've been looking at, in particular, the issue of asset building in immigrant communities
Right.
that has come up is the collectivity versus the individual,
Right.
or the collectivity versus the family. And the buddy mooching is a upper middle class college variation of the whole issue of, if I have money, it actually belongs to an extended community, not just to me. And
Or
it's
at
a
least the
very
buddy thinks
important,
so.
yes, right. It's a very important issue in asset building, and it's also a very important part of the reason why getting people into bank accounts so that at least it gets out of the house is useful.
Thank you. Before we go, I did want to give a question and acknowledge our colleague Mark Schmidt, the C-SPAN audience knows this, who is leaving and didn't want to ask a question, but he's the brand new editor of American Prospect. No, he gave up his chance to ask a question. You get to ask a question. I do want to acknowledge he's our new editor, well, not our, but the new editor of American Prospect magazine here in town, who works a lot on these issues. But I'm going to give the last question to you, because I'd like to give Peter a time to sign books and talk to all of you. But yes, ma'am.
Okay. Iris Portney, independent contractor, and I ask this from the perspective of someone who's worked in government, with government, and who also for a few years was the chair of my professional association's insurance committee in terms of trying to find sources of disability and health insurance for groups, et cetera. The question is for both of you. And it relates to what might be the potential role of government in two areas. What is this on?
No,
okay.
I'm just-
Okay. You're focusing. What can it be, and also what is it likely to be? The first is on financial literacy, and the question is, who should be doing that? Should the government be providing the information or mandating it, paying for it, providing?
So financial
blah, blah, blah?
literacy, one,
Yeah.
and two?
And the second one is on the government's ability to provide access to jobs at all levels, which are unlikely to dump their benefits at some point, which means government jobs. Because what has also been going on over these last 20 years is progressive contracting and subcontracting out of government jobs that used to be careers. And so my question on that one is, are either of you hearing at any level any interest in governments in terms of trying to reverse this a bit? Not massively, a la the New Deal, but trying to bring back in jobs.
Great, got it.
You go first.
Okay. Well, first, as to financial literacy, the answer is all of the above. That the government has a huge role, particularly in K-12, and that role has been totally, or not totally, but almost entirely ignored. I also think that the government has a further role in probably not doing it directly, but in supporting efforts that are for adults. But I actually think that one of the things that we're working on pretty hard is the concept that there's also an enormously important role that is a combination of government oversight and provider doing that generates what we've been calling just-in-time financial education. So the education comes at the point where the product is going to be used. It's one of the reasons why homebuyer education has always been much more effective than more general stuff. On the jobs front, as long as I suspect that one of the problems here is an accounting issue. I'm not enough of an accountant to, in fact, I'm not anything of an accountant. I'm not an accountant, therefore I'm not entirely sure whether it's an accounting issue, but I have a funny feeling that this is one of those classic cases of public goods that are incorrectly valued so that it looks like outsourcing is a good deal cheaper than it actually is. And to some extent, changing that may well change the dynamic.
Peter?
I guess my comments about financial literacy would run along the same lines as my comments about education generally. It's good to be financially literate. It's bad to be financially illiterate. I don't think it's going to solve the underlying problem. I think that there are some risks that we have to pool, and I think that being conversant with them gets the conversation about them started, but it doesn't get the pooling done. On the issue of I'll agree with Ellen on the issue of public employment. Given the state of both the federal government's finances and state government's finances, I don't see some massive new. I don't think CETA is coming back anytime soon.
In wrapping up, I wanted to just comment. Some years ago, again, the '90s, when I was very focused on the question of how to approach the working families' lives in the state of New Mexico, and I was thrilled because we were 48th in per capita income in the country at the time, and during my tenure with Senator Bingaman, we moved to 47th, and it was a little bit of a leap. But at the time, there was a question that I posed to Alan Greenspan once. And I think it captured, again, this is top down, but nonetheless it captured what was going down at the top without regard to the bottom, was he viewed his job, and he viewed the jobs of people like Bob Rubin, then at Treasury, as doing whatever it needed to do to decrease the level of friction by which capital and financial transactions move through the world. It was to get it higher and higher in speed movement. And so I asked the natural question. On highways, when you have higher and higher speeds, you get casualties. You create anxieties, you create problems. And it was very interesting, and he just sort of steamrolled right over me. But it was an interesting question, and it was, as I mentioned, Eddie Luttwak during the time of thinking about turbo capitalism, where you had embedded in our policy debates assumptions about individuals we're going to get used to moving from 1 or 2 or 3 jobs in their lifetime to 13. So we were going to have the turbocharged economy and the turbocharged worker who would be able to move. Well, I got to tell you, when we began to work, with Michael Calabrese, my colleague here, we were working on trying to figure out, okay, how do you make pension policy work in that and get serious portability? How do you get companies, for instance, to put aside money without the requirement, what's called a reverse match, instead of being always dependent upon the the employees back. There were lots of things that were doable that would have made that shtick at the time more believable. But you saw none of the interest fundamentally. At least you did see interest, but none with 50% plus one support in the Congress that would actually help arm workers and families with the ability to deal with the dynamics of this faster and faster charged economy. And so I really value your book. I'm fascinated by the notion of coming up with new ways to calibrate, benchmark, and think over time in a different data set, because it is missing. And I often feel in lots of the debates we have, I feel like we're working with a very thin level of numbers, and we're trapped with sort of old structures of dealing with things. So I very much value your effort to try to think from a bottom-up perspective. But this is not a new debate. It's been going on for a long, long time. And I think it's a big contribution. Did you want to make a comment right before we wrap up, Peter?
Well, I just say with regard to what you just said, Steve, I think the reason why you didn't see 50+1 is because the assumption was that the economy on its own would produce the jobs that you would keep jumping to.
Right.
And that was the happy story that Bill Clinton told. It was the
Right.
amendment to the Reagan story about
And
markets.
that was the happy story.
It
Clinton
was
would
the
tell.
happy story. And
Yeah.
one of the things that strikes me about where we are at this moment is that Americans do not have a clear and plausible story about how we're going to go here forward in our material lives and in the life of our nation, and be successful.
Right.
And I don't. It seems to me that the presidential candidates are going to have to address it. I'm stunned that they have not so far.
Right, and I should also say, because I know I'm going to hear from a lot of my own readers in the Washington Note, but also many people on C-SPAN, that of course I know it's not 50%+1, it's always 60% in today's world, so my apologies. You've got a great cover note here from Mark Shields, who's often at New American Foundation, of course, a NewsHour commentator and columnist. But he says, if you have time to read only 2 books this year about the condition of the country and the challenges we all face, do yourself a favor and read High Wire twice. What a great bio! But with that, I commend High Wire to all of you. Congratulations to Peter Gosselin, and my thanks to Ellen Seidman for joining us, and all of you for joining us. Thank you.